Hey guys, Greg with PlanetGreenZen.com here, and it's time for another audio blog. And for those of you who've never been on Planet Green Zen, or at least his YouTube channel, pretty much what I do here is I love to inspire people in 5 different areas of life, which I believe will give you a holistic yin-yang balance, mentally, physically, spiritually, financially, and socially. And so what I do is just like to put content out there, just put it out to the World Wide Web, is what they used to call it, and anyone who catches that electronic or digital information, hopefully it inspires them to do more than live a mundane life, because again, we're all taught to live one way in life, and I just want to inspire people to do more with their life. So today's audio blog is entitled ETFs or mutual funds. And again, what I'm doing, for those of you who've never been here before, is I actually started to write blogs over a year ago. Which I do have, planetgreenzen.com is my blog. So if you can click on the link in the description below, it'll take you to planetgreenzen.com. But now what I'm doing is actually translating these blogs into audio form. So that's why I call this an audio blog, because I'm recording it so then you can hear it. And it gives you a little more flexibility with listening to this, or instead of reading it, if you're driving or working out, you could just pop this on and just listen to it from YouTube. But this one is specifically geared towards people who are like I was when it came to investing in the stock market. Now I know there's a lot of different views on the stock market, whether yes or no or don't do it, do it. But again, if you want to just get your feet wet, get started, have something that sits there, this is for that. So again, I just to forewarn you, I am not a financial advisor. So please keep that in mind. This is just my viewpoint and my opinions. And again, if you decide to do things, please do your own due diligence and do your own research and get a financial planner if needed. But again, just going to say ETFs or mutual funds, which one should you go with? If you've been hearing good and bad about both, should I do an ETF? Should I do a mutual fund? So hopefully this helps you out. So here we go. If you're like me, when I started to invest, I was very overwhelmed and confused with all of the investing terminology and variety of investing packages many companies had to offer. I've only been investing for about a month now. Now, again, this is over a year ago. I recorded this in June, or I've written this in June of 2017. Okay, so let's go back about a month now. But 30 days ago, I had zero knowledge when it came to anything about investing. Everything from A to Z regarding investing was like a foreign language to me. I started to do some research by reading and listening to podcasts to help me improve my ignorance in regards to investing. Too bad we aren't taught this stuff more in depth in school, right? Or we'd all be driving different colored Maseratis every day of the week. Just kidding. I'm not a financial advisor of any sort, but I do believe with the knowledge I did gain, I can shed a little more light on investing to some who may not have been on the same boat as I was. And again, who doesn't have any clue what to do when it comes to investing or where to start. So that's why I've written this blog. So you read it, and hopefully this gives you a little better understanding to where it helps you pull the trigger, start to do more due diligence and learn. I still have tons of years of learning ahead of me, but it's off to a fun start. Now, if you've done some homework on investing, you may be asking yourself the questions listed below. There are many more questions people ask before one would move forward and invest, but I kept this to 5 simple and most common questions I've thought of when I first started out. The first question is, what is the stock market? The second question is, should I invest in ETFs or mutual funds, and what are they? The third question is, how do I buy or sell stock? Fourth question is, how much money do I need to start investing? The fifth question was, what is the difference between a stock, a bond, and a share, and why do people invest in them? So let's break down each one. So what is the stock market? The way the stock market was described to me, simply put, was to think of the stock market as a swap meet market in regards to both. It's a marketplace set up to where people can do exchanges and trades. The stock market allows publicly traded companies to issue and trade equities, which are stocks of publicly traded companies, bonds, and some sort of securities to exchange pieces of the company for capital. Investors of the company become shareholders, or simply the investor owns slices of the company on the market, which he or she decides to invest in. So again, that hopefully was clear to you guys of what the stock market is. So that was explained to me that way, which helped me understand it a little bit more. Next question was, should I invest in ETFs or mutual funds, and what are they? Let's start with breaking down each one first. In ETF stands for Exchange Traded Fund. It's designed to track an underlying index or mimic the performance of one. For each, there's a very popular index that investors like to invest in called an S&P 500. S&P stands for Standard & Poor's 500. This index tracks 500 of the best performing U.S. based companies such as Apple, General Electric, ExxonMobil, and so on. An ETF is designed to mimic the performance of the S&P 500. An ETF can be managed by a single person or a money manager. Typically, people who want to venture out on their own and invest would typically start with a low-cost ETF. And again, this was recorded a year ago, so the stocks that are listed here could be a little slightly different now. So again, keep that in mind. A mutual fund is very similar to an ETF, where it's made up of a pool of funds gathered from a variety of investors, but is typically handled by a money manager who handles investing funds for investors. There's a ton more of learning regarding each portion, regarding each portion, and then also what will best fit your needs. But I just wanted to provide the stepping stone for a beginner that is barely getting their feet wet with investing. Below are some pros and cons with both types of vehicles. The choice is yours. I highly recommend using Investopedia.com to fill in the gaps. They have tons of great information regarding investing in the market. ETF pros. Greater flexibility regarding trading, diversification, more of a passive fund to where you don't really need to manage it, just let it sit there and do the work for you. Management expenses are significantly lower than mutual funds, offers tax advantages to investors, can be used with an IRA account. ETF cons may be limited to larger companies. Costs of share could be higher than investing in the specific stock itself. Dividend yield may be lower than investing in a specific stock. And for those of you who don't know what a dividend is, it's pretty much a payout of a stock. So if you invest in a stock market based on a company, it may do monthly, quarterly, yearly payouts to where they, when they make money, then you get to take advantage of that. You get small portions of that direct deposit into your account. Now, mutual fund pros. Again, diversification, professionally managed so you don't have to worry about doing anything. Mutual fund cons. Professional management fees, not tax efficient. Not an IRA account. Pay more in taxes due to the capital gains distribution. Costs associated with mutual funds will decrease your overall rate of return. Next section is how do I buy or sell stocks? You will first need to decide which brokerage firm to use that will manage your buying and selling of stocks and bonds. A brokerage firm is simply a financial institution that stores your capital. Think of it like a bank that holds your checking and savings accounts. I like to use Vanguard personally as my brokerage firm, but everyone has different needs. Some brokerage firms have more fees than others. I recommend using nerdwallet.com to compare the brokerage fees to see which best fits your needs. This website is easy to use and understands when deciding which firm to use. It also compares most of the well-known retirement accounts and helps you decide on which ones to use. I would recommend opening up a Roth IRA via Vanguard, but that's just my opinion. Next question was, how much money do I need to start investing? A better question to ask before thinking about investing is, do you have enough emergency funds for at least 5 months in case you get laid off from work? If the answer is no, then you should really think about saving money first in order to have a cushion. Second question to ask yourself is, do I have any credit card debt or outstanding loans? If so, then you should really get those paid down first before thinking about investing. Once you are out of the clear with debt, then you can start to put your money aside that'll be used for investing. I would say you can start with $1,000 and build up from there. Next question is, what is the difference between a stock, a bond, and a share, and why do people invest in them? Stocks and shares typically refer to the same thing. A stock or share is when an investor owns part of a business or corporation and has access to a portion of the business, assets, and earnings. Let's say you want to invest in company A. I like to use Yahoo Finance to search for ticker symbols of companies and to get detailed information on them. Let's say you want to see how many shares a company A is divided into. You can use Yahoo Finance to search for the company and check the shares outstanding. That'll inform you about how many pieces of the company is divided into. A company A is divided into 100 pieces, let's say. That means you can invest in pieces of that company, and that's how you become part owner of a corporation, by investing in the pieces, aka shares or stock. If you decide to invest in 10 shares of a company A, then that means that you own 10% of the company. If you purchase a stock low and sell high, then you'd be making some healthy profits. Knowledgeable investors sometimes can receive between a 10 to 20% return on their initial capital invested. People tend to invest in stocks due to the ROI, which stands for return on investment. that can far exceed what you may get from a bank or have a typical savings account. Now, a bond is an investment into debt. Some people may ask, well, what is a bond? Here's the explanation. A bond is an investment in debt. I know that sounds a bit weird, investing in debt, but just hear me out. Let's say company A wants to fund a project or open up another location, but does not have the capital on hand to fund the project. Instead of going to a bank and asking for a loan, what the company would issue is a bond or a coupon to investors for the amount needed to fund the project. So let's say company A needs $100,000 to fund the project. Company A will split the bond into 100 pieces. The coupons will be $1,000 per coupon. An investor will give company A $1,000 to help fund the project. And the reason why the investor will want to invest in the bond is because of the interest rate. In this scenario, the tables are flipped 180 degrees. So the investor becomes the bank and the company becomes the borrower. Think of this scenario. Let's say Sam wants to buy a house or a car and doesn't have the capital to pay for it outright. Sam will need to obtain a loan from a bank in order to finance the house or car. But part of the bank's terms and conditions states that Sam will need to pay an interest rate on the loan, and that's how the bank makes money off of the issuing loans. So hopefully that makes sense to you guys. And you can start to think about, again, how wealth is actually created here in the United States and how you can actually create wealth yourself. So keep that in mind. This is just to plant small seeds. Going back to understanding bonds, company A would issue 100 coupons as $1,000 a piece to investors. Part of company's A agreement is that they will pay the investor an interest rate on the coupon that is being purchased by the investor and refund the initial principal that the investor gives to fund the project. An investor would buy one coupon for $1,000 per company A's terms that'll pay, let's say, 3% to the investor for over 30 years, and then pay back the initial $1,000 after 30 years. The investor will receive a check for $30 a year for 30 years, summing up to $900, and then would receive the initial $1,000 capital as invested after the 30th year. Meaning that the investor would invest $1,000 and after 30 years would receive $1,900, gaining $900 over a 30-year period of time. Now that is a lot more, there's more to learn about bonds. This example above did not factor in inflation over those 30 years, as the loan would be more or less attractive based on inflation, but hopefully that makes a bit more sense now regarding what bonds are and how they work. Now that you have a very basic understanding of investing and how it works, go learn more and study, so you can make more well-informed decisions and build your investment portfolio and wealth. So below on my blog, planetgreenzen.com, I have highly recommended books. So I'll go ahead and name those off, and I will put them in the description below on YouTube just so it's more convenient for you guys. But this is what I said on the blog. I highly recommend investing and reading the below books prior to committing to a certain method or taking anyone's advice. So the first book is called The Education of a Valued Investor by Guy Spier. The second book is The Dhandho Investor, The Low Risk Value Method to High Returns by Mohnish, Pabrai. The third book is The Little Book of Common Sense Investing, The Only Way to Guarantee Your Fair Share of Stock Market Returns by Bogle. The fourth book is A Random Walk Down Wall Street, The Time-Tested Strategy for Successful Investing by Burton, Malkiel. And number 5 is The Intelligent Investor, The Definitive Book on Value Investing by Benjamin Graham. I also recommend checking out Preston Pish and Phil Town on YouTube to help you understand how to invest. These guys are great and help break down every component you would need to know before you would start to invest. So again, I hope you guys did enjoy this audio blog on ETFs versus mutual funds. If you have any questions, just comment below. Let me know if you like this, if you didn't like it, what else you want to see to help me improve this channel. So please subscribe, share, like, and I'll talk to you guys soon. Thank you for your time.